There's a key interest rate in the Treasury market that didn't move much yesterday, even as oil collapsed as much as 7% at its low of the day. And that disconnect should be telling you something more than just the geopolitical headlines we've seen in the last 48 hours. Here's why it's important. Interest rates didn't fall nearly as much as you might expect, given the drop in oil, which reduces inflationary pressures. But the 30-year Treasury bond yield held at 5.1%. And if indeed falling energy prices were going to drive down inflation, that number should have come down a lot more. What it's telling you is there are a couple of things happening here that investors may not be paying attention to. One of which is the Treasury is still selling a lot of debt. The deficit is going to approach $2 trillion this year. That swamping amount of supply hitting the market is keeping interest rates up and could put your portfolio at risk if you own too many long bonds, as they are called. That's the 30-year Treasury or even the 10-year note. You have to keep an eye on those two debt instruments because the bigger the deficit, the higher the interest rate, or the higher the term premium, as investors like to call it, that could devalue your bond holdings even if your stock holdings are doing well. Something to keep an eye on as interest rates are higher than they should be given the big drop in oil prices that we've seen. Now, if you want more information on this and other topics, comment SUBSTACK and I'll send you a link to my newsletter, The Message of the Markets, and follow me on Instagram for more information like this.